Okay. Good evening, everybody. This is Jeff Scott. This is 12/15/2013. I'm a little bit later than normal tonight. It is, as you can see, about 9:20. And as I always like to do, let's take a quick look at the futures and let's get an idea of what the market's doing at this point of the game. Well, that can't be good for the bulls and the China bulls, but of late, good news is bad news and bad news is good news. You see S&P 500's up a little bit, NASDAQ up a little bit, small stocks down a little bit, Dow up a little bit. So relatively nothing is how I would best describe it, and let's just put it away for now. So as usual, this will be my top-down review with some looking at some various tricks for shortcuts. I kind of entitled today Santa versus tapering. I think we'll see a lot of interest in what comes out of this week's Fed meeting and whether or not there's a decision to taper. Lots of reasons to argue for the taper. The economy seems to be improving. And frankly, from a long-term perspective, it would be nice to see the economy good enough that the Fed doesn't need to be propping it up. So hopefully any taper will be perceived as a positive sign. But we do know over the summer and September, whenever tapering is discussed, the market seems to sell off. There's my email address, jeffrey@highgrowthstock.com. Disclaimer, as usual, this is for educational purposes only. Any recommendations are in the spirit of education, not investment advice. I'm a doctor, not a broker. Most physicians lose money with their investments. I am not affiliated with any software vendor or trading company. Tools that I demonstrate are those that I use in my daily trading. I have paid for everything that I demonstrate. So just want to bring up to date on our upcoming meeting. I've got a fair amount of people have already signed up. I have a hard stop when I get to the limit on my room, and I was able to, as you'll see in a few minutes, lower the price because I cut a better deal with my condo on the room rental. Basically, the title is High Growth Stocks, how to find them, how to trade them, help you identify them, find them, what triggers to buy them, once you buy them, how do you manage them, and then how does seasonality come into play for everything above. George Lee is the keynote speaker. George Lee is an outstanding trader from Canada. I've had the luxury of getting to be friends with him over the past year. I've been following him for a number of years, just as a common sense approach that people find extremely attractive. Chris White, who is a trader, but also a techie, was involved early on in Microsoft Office, has a great program called EdgeRater, which he'll be using to help both backtest what George and I do, and then to automate it. And he's done a great job of automating George's tools themselves. The original price was $750 because I was able to cut the cost of the room down. As you'll see in the next slide, $750 will include the indicators, $500 without the indicators, and $850 for a couple. Meet and greet reception will be on the 14th. I'll mention more about that. Ignore the comment about the first 10 attendees. Anybody paying $750 will get my indicators for TradeStation. All attendees will receive code for indicators in Thinkorswim for scanning and charting and instruction of how to input them and use them. Attendance is limited on a first-come basis. My contact information, again, just stop the movie at any time to write it down. So I had a couple of questions about, does this compete with, and is it the same meeting as you get in Palos Verdes Estates? And I would say no. This meeting is really an amalgamation of a little bit of the Palos Verdes meeting, and then the Anaheim George Lee Summit and the Magenta Trader Vegas Summit. And we've tried to take the best up from each of them and really make this practical about trading and not just philosophy. There certainly will be some philosophical discussions, and I think that's necessary as we go through the different things we do and why. But we really want to spend a lot more time in actually finding stocks to trade, how to trade them, how to manage them. As I mentioned, reduced price, as you can see here. Note, if you've already sent a check, no worries. As I said early on, everybody will get the same opportunity. So if you've paid $750 and you don't want my indicators, we'll give you a refund when you're here of $250. In addition to lowering the price, to make life easy, we'll provide breakfast and lunch on Saturday and Sunday, as well as refreshments throughout the meeting. Right now, Friday dinner will be most likely at a restaurant with individuals paying for themselves, but in a private room, so we'll have the opportunity to have George and I do some introductions and Chris and start the ball running. For those that can't get here to Saturday, no worries. Friday we'll be mostly getting everybody up to the same place on their tools, and I'll have a online session that week before the meeting for those that can't get to Friday dinner. The agenda, I really look at this meeting as being 3 parts. Part 1, setting up your tools for success, and we'll use a number of tools: HGSI, TradeStation, Thinkorswim, EdgeRater, Magenta Trader, so on and so forth, and then the websites that George likes to use. Part 2 will be, now that you've got the tools and you've learned how to scan and your scanners are set up, how do you find setups using those tools? Find stocks that have characteristics that might match up with the things that you might be interested in buying and selling. And then once you find those things, when do you trade them? So we'll scan for setups as we did learn in part 2, but then talk about different triggers, money management, and then I call it your nightly review, hopefully leaving at the end with a session of preparing for Tuesday's market and trying to show how you condense the entire weekend down into maybe a 45-minute review to help you make your choices and get ready for the market the next day. I said Tuesday, not Monday, because it is President's Day, and that means you've got an extra day to get home, or, as I mentioned, stick around and come to the Traders Expo. I also like to comment, yes, I do know that Sunday is Valentine's Day, so what a great place to bring your spouse, and without sounding too sexist, the wives and the husbands of attendees. My wife is going to look into potentially setting up some spouse programs and potentially go to visit museums. Obviously, great place if the weather is conducive. Going forward into my usual meeting, and I think if I was to do a series of online or live sessions and online, and roll them up into one term, I think I would say it's the Be Your Own Guru Tour. And the reason for that is I'm tired of people thinking that they can rely on a third party to make them money. You have to do it yourself. Now, part of doing it yourself might be to find a couple of good third parties that you trust that outperform the indices. But I'd rather see you become your own guru, and that's what these meetings are about. So to me, it was finding smart people that I could learn from, whether they were Ian Woodward and Ron Brown of HGSI fame, Alexander Elder, a Russian psychiatrist, moved to the U.S. and has published a number of great books, whether it's William O'Neill, the godfather of growth stock investing with CanSlim, or his disciples, Gil Morales and Chris Katcher, with their pocket pivots and Bible gap-ups. Is it Van Tharp with money management, Bigelow with candlesticks? And Ronald Bronke is probably my favorite of the how do I make money off what I have and take low risk, so writing calls and naked puts for monthly cash income. Here's some of the websites, and again, you can stop the video at any time to write something down. And during the meeting, these are some of the tools that we'll clearly utilize. And I will show you my desktop, and you can laugh at all the icons and different programs I have. I've bought a lot of things that I never use. And frankly, if I was on a desert isle and I had to pick what I'd want to work with, these are what I would have to play with. My real-time charting platform, and a program to analyze after the market's over, which is HGSI, EdgeRater, which is great for automation, as you'll see in a few minutes. I like seasonals, and then MarketSmith is a nice program to supplement. At some point, I expect HGSI to be real-time, and when that happens, I'll have to question whether I need both trading platforms or not. I, unfortunately or fortunately, have made substantial investments in both platforms and paying third parties to create indicators and strategies and auto trading platforms for me, and I think I'll be reluctant to give up either of those platforms for a while. So I could give a lot of negative reasons about this market: divergences abounding, new high, new low numbers falling, Hindenburg, and then I look at something like the next two charts, and then I remember that there's both currents. There's arguments for strength and arguments for weakness. Now, one of the things that I love about HGSI is I can, or you can, take a list of stocks and then create your own custom indices. Now, at the meeting in October, we took a list of leading stocks, and then we've learned over the years that by measuring and monitoring and following that list of leading stocks, you get an early warning system of the market. And, you know, HGSI, we pretty much picked this list back here where my arrow is, getting close to the top. And the reason why we use this, again, is this will fall before the major market falls. And what we saw is it went sideways, which I guess there's been volatility, but in many ways we're at a similar place in the major markets than we were perhaps a month or 6 weeks ago. But what did we see happen to the LLUR index last week? Despite maybe a negative feel towards the market, you got a breakout out of the squeeze with pocket pivots and two kahunas on Thursday and Friday, a DI crossover. Everything has turned green. So despite the concerns, and I have them too, that this market wants to roll over, the LLURs, if anything, had a positive week. So that would be one sign that would tell me that maybe not yet in regards to a rollover. I had a lot of questions about what went into this list. These are the stocks, and to be picked, you had to be from the lower left to upper right. You had to be a leader. We limit the number of leaders per industry, and we put together a list. We put an index on that list, and we track it. Now, another list I talked about last time were the Canaries, and again, these have been the big kahuna leaders. Forget kahuna in regards to Ian's charting platform, but the big guys in the market over the last several months, years, etc. And we also talked that this is another way of gauging the strength overall of the market. And look at this. These guys gave us the old, we're collapsing right down to the 65-day exponential, which is something I'm playing with, bounced off of it and running back. And to my little eyes, whoops, didn't want to do that. I almost think that we're getting ready to go out, to potentially break out to new highs on the Canaries. So that would be two bullish arguments about why perhaps this market is not done yet. So the same slide as last time. Bullish seasonality, improving economic picture. Indices had been moving upward, went sort of sideways, except for the NASDAQ was up this week. The Dow and S&P were down. We'll look at what stocks are outperforming, but we've been watching high relative strength stocks lead. Bearish signals. Well, the Hindenburg, confusing, and I'll talk about it when I get to Edge Rater. No major correction over a year. Junk off the bottom has been leading the last several weeks, but maybe that's changing as you saw the Canaries turning around. And an improving economy means the Fed will reduce, or should be reduce taper soon. So it should be reduce or taper the buying of instruments soon. Upcoming HGSI meeting will be in March 2014. And again, my February meeting is complimentary. It's also an opportunity to do a meeting on the East Coast. The software, highgrowstock.com, free trial, no credit card. Those of you that are planning on coming to the meeting in New York City, I'm going to ask you to take a trial if you don't have it. And again, we'll have an online session before you get here to make sure you're ready to use it. On the website, under investing strategies, which is right here, I don't know why I'm pointing with my finger, you click on that, it'll drop down my name, and you can get access to a lot of my videos, or you can search for the letter JAS Cancer Doc on YouTube to find them as well. So just to follow up here, Summit will be February 15th and 16th with an optional the night of the 14th. price 750 including the indicators, 500 without the indicators. I have been considering selling the indicator set for between $500 and $700 by themselves. So if you have TradeStation, the indicator set probably makes a lot of sense. And then really become your own guru. Investing as a business, make sure the right employees, which is tools and software. Continuing education matters in most businesses, including your trading, which is why we hold meetings like this. Trade the market you have, not the one you think you should have. So enough of the PowerPoint. And let's shut that down. Save since I made that change. I kid you not that there are very few programs on the marketplace that I either don't have or don't try. But you see I go to the same ones every time because at the end of the day, I want to get really good at what I use and the rest become a distraction. I like to invest, I've thought about this. I guess I like to swing for the long ball, swing for the home run. And I do a lot of trades. I get stopped out quickly when I'm wrong, and I try and hold on for a long time. And when I look at my portfolio, I've got some stocks that I've held for quite some time, such as Valiant, VRX, Celgene, Jazz Pharmaceuticals. And so I do a lot of trading. I have a lot of positions. And I have to figure out which are investments, which are short-term trades. I'm a swing trader, but when stocks work really well and I get up a lot, I have a tendency to become more of a position trader in those stocks and give them a little bit more room while I go in and out of a lot of positions probing to find those winners. So I used to think I needed a lot of programs to do that, and I really don't. And which is why at the meeting we'll be using a limited number, not everything on my desktop. TradeStation, just an idea of what my indicators are that I keep talking about is between here and here. I'm able to scan for red candle highs, green candle lows, ISO failures, squeezes, mogul breakouts and breakdown out of a squeeze, and viable gap ups, also pocket pivots. And I like doing this on a real-time basis. The rest of the stuff are things that I've bought that I can't sell or give away. Jan Arps, JN, ARPS, has some great indicators that I use for finding pullbacks and measuring the strength of trends, both from a radar screen and a charting perspective. So there's a lot of different tools that I use, but the set here that has the exclamation point JS, these are all the ones that I've paid for to get programmed that will be packaged in the indicator set. So I'm only going to look at this real quickly, as I always do, going in to look at the elder indicators on the major indices. The Dow was down for a second week in a row, I believe, and you could see a pyramid formed on Friday, a red stick, which tells me that I shouldn't be going long. Blue on the weekly, blue on the monthly, not down all the way to the lower envelope, which we've taken out in the past on these corrections. And as you know, one of my biggest concerns was in this market was that, and I'm not real good at drawing with this program, but let me just try. I do think it's worth a comment. I was very concerned that we got such a higher high here, yet for that same period of time, we did not get a higher high on the MACD. So there's clearly divergences there, and it'll be interesting to see if we can take out the lower low here, which would show no divergence on the way down. But weakness in the indice, clearly the red is concerning. The S&P 500, similar, and again, higher high here compared to back here, and it didn't even break the midline on the MACD histogram, which is very worrisome. We talked about it last time as a signal that this was a market that looked like it might want to turn over. If I look at the NASDAQ, it might be a little stronger. which little will be the opportune word there. It's in the midline, but it's also red, blue on the weekly and the monthly, and it too higher highs here, and both the line and the histogram showing divergences. So that's enough here. It confirms the divergences that I've seen the last couple of weeks, and let's forget about that for a while. I think my favorite tool, as you've seen over the last couple of weeks, of really understanding retrospectively what's gone in the market and stuff that I do on a nightly basis, or a couple of scans that I do in EdgeRater. So I just basically put them into a spreadsheet for speed. So I usually take all the stocks in the market and look at them over the last week, and I look at them on the basis of gain versus certain characteristics. So the first thing you see is, doesn't matter what ERG you looked at, stocks did poorly or lost money this week. And in fact, the stocks that we usually like, which is about 20% or 20 ERG points below the top, they actually had a pretty awful week. But everything had an awful week. Was there any relationship between EPS rank and gain? Those that don't make money actually did worse this week. From a relative strength perspective, those of low relative strength did actually, let me say this again, the higher relative strength, higher EPS rank stocks lost more than the lower EPS rank. On a relative strength basis, the lowest relative strength stocks actually lost less than the higher relative strength stocks. And group rank, it's hard to see any major difference, except the weakest groups had the biggest losses. A D letter rank, last week I commented that the E rank groups seemed to be doing better, which was junk off the bottom, and they lost less than some of the higher ranked groups. So still perhaps had some of the weak sisters leading this market and the stronger stocks leading it down. HGS boxes versus gains. We like to buy box 1 and 2 and box 7, and hard to say that they were the best ones to be this week. It was a tough week, and it pretty much didn't matter where you looked. You probably lost money if you were long. When you look at on my group performance analysis, looking at, we bought these groups at end of day on Friday the 6th and sold them end of day on Friday the 13th, except for the fact of taking into account the gap up or the rise in stocks that you might have seen on Monday before the market sold off. HGS 100 was down a little bit over a half. The IBD 50, Market Smith, and my All-Star GIFs were down about 1%. My stocks are down in that area if I had held them, which isn't the case. And then also I have some of them were short. And the buy watch was down about the same. And the S&P 500 was down 1.65%. So when you see this much red and the S&P 500 down that amount, you know it was a difficult week. Now, last week I commented about the Hindenburg and why I thought we might want to pay attention to that. I'm very confused, to be honest. If Myrna, if you're listening, I'm curious what Norman has to say. I tried to email you about that. Norman Prospect being a world-class economist who's married to one of the HGSI folks, so she teaches him everything, I'm sure. And to get a Hindenburg, certain things have to happen. Your new highs and new lows both have to be greater than 2.2%. Your moving averages have to be rising. Your McClellan has to be below 0. And your new highs have to be less than 2 times the new lows. And if you look at this, there's a lot of new highs, a lot of new lows, rising market, McClellan less than 0. It gives you a very mixed picture. And a Hindenburg omen is a mixture. It's a mixture of the little guys like us buying while the big guys are selling. And it's often a sign of a market top. So everybody talked about this one, which was on the 6th. And then I heard comments about additional Hindies occurring last week. Now, it's depending on how you what stocks you're looking at. whether you're looking at preferreds or you're looking at just common, it may make a difference. And one thing to point out here is on the 9th, which was Monday, the only reason we didn't fire was because the new lows were only 1.65%. On the 10th, we were within 0.04% of firing. And then as the week went on, Wednesday, Thursday, Friday, we were less than 2% on the new highs, so we wouldn't fire there. If you think about a lot of new highs and new lows on the same day, there's a lot of confusion. So depending on your source of data and what you actually use on this, it's very possible that you saw more Hindis for the week. I think the message to me is clear, which is time to be concerned, but I think there's a lot of conflicting signals to be bullish or bearish at this point. Bill Roberts on the HGSI board, I think, did a wonderful review of the Hindi and left me feeling that, it calls for a modest correction and not necessarily the end of the world. Bucketology, I thought this was also interesting. I take the S&P 1500, run it through EdgeRater in about 3 microseconds, and it takes the 1,500 stocks, and first it tells me how many are above or below the midline and the Bollinger Bands. 70% nearly are below, that's bearish. And then it takes it into deciles below and above, and then between the two divides them up into 10 bands. And you could see that the majority of stocks are below the midline, and only about 8% are below the lower Bollinger Band. Now, just for the context, this is what it looked like on Wednesday, and you could see nearly 20% of stocks in the S&P 1500 were below the lower Bollinger Band. And then this was Thursday, and the number dropped to 15, and now it's down to 8. So really, the market perhaps has had its peak in badness. God, I hate to, that's a real word, and improved from Wednesday to Thursday to Friday, but no one says it can't go back the other way around. From the market's perspective, with the percent B and then the bandwidth times percent B, green is good, yellow is indeterminate, red is bad. On Wednesday, we had kahunas across the board, and some big kahunas in the markets, and we flipped from what's been very bullish, mostly green, to solid red. The Russell and the NASDAQ being the ones that remain yellow. But this is clearly a market that has changed from a couple of weeks ago when we had a sea of green after some kahunas up. So a market that, is clearly under pressure, and the question remains whether it rolls over or is there another leg up. Remains to be seen. And then lastly, another big plug for EdgeRater. If you're a fan of George Lee, as I am, wouldn't it be nice to automate his squeeze and breakouts? And these were just 4 stocks. And we'll probably look at Trox and Capstone later today that had multiple breakouts coming out of the squeeze, which is something that George uses as potential screening methodology. So now let's jump into HGSI and get a sense of what the market is doing. And I think I'll show you, unlike the Canaries and the LLURs, I'm going to show you some concerns of why there might be, or why I'm seeing some weakness in the markets. So major markets plus, top-down view, which is all technical but not just the last couple of days. And what do I see come to the top? Things that would go with concern: volatility, bonds, silver, up near the top. Interestingly, silver outperformed compared to gold. Now, what was on the bottom of our list were the NYSE, utilities, industrials, and NASDAQs, big stocks. So over the last several months, you almost never see the VIX up on top, and we usually see the indices up there, so that could be a sense of a change. If we look at 5-day performance, well, this is why the VIX is up there, up over 14%, silver and gold positive around 1%. And gasoline, utilities, small stocks doing worse than the big stocks, but they all did pretty badly, as you can see, over the last 5 days. Friday, not really a big change. Volatility was still up. Gold and silver at the top. The small stocks started perhaps to lead the recovery, although one day does not make a big change. To look at these very quickly, do my usual rapid fire review, at least of some of them. So here's the S&P 500 eventually, and we can see that the S&P 500 continues in a nice, steady uptrend and has had a series of these modest pullbacks. It's still above the 50-day moving average. Clearly in a pullback, you could see my bongos went red. There's no force because there's no volume. So S&P 500 uptrend under pressure. It's at the bottom of the Bollinger Band, the place that you might expect it to rebound. And you can see you had a big change in the Bollinger Bands and the high percent B and the Kahuna down that occurred on Wednesday. Looking at other major indices, let's take a look at the NYSE, which is a mixture of big, small, and medium. And a little bit dirty here, but it got below the 50-day moving average, so a little bit more pressured. Also sitting on the lower Bollinger Band, again, places that you might expect a bounce. If I look at the NASDAQ, and I don't practice these, so if I change my mind and go back to something, I have no text. I don't follow a script. The NASDAQ looks a little bit better as it's above the 17 in the middle of its Bollinger Bands, but it too is in pullback mode and under some pressure. If I take a look at the Russell 2000, small stocks right on the 50. So if you're bullish, you could say that all these are setting up at perfect buy points. And if you're bearish, they're breaking down. So I think a lot has to do with what happens over the next couple of days. If this 50-day moving average is broken, then look out below because there's quite a ways down to the 200-day. That Canary and LLU chart are meaningful to me because while the major indices look like they're under pressure, the leaders seem to be moving up again, and they have a tendency of leading the indices up and down. So that might be actually a very bullish thing to watch. If we look at the VIX, this has been my whack-a-mole. Every time it gets above the 200, it gets pounced down. It held there for a couple of days. Let's see if it can continue to move up. If it continues to move up, anticipate greater weakness. When it stops moving up and falls, that's when we usually see the market move up. Gold and silver, I guess you'll have to look at one of them so they look the same. In a downtrend, until gold or silver breaks above the 50, you're going to be in a downtrend. Frankly, until you're above the 200, you're in a downtrend. Impressive break above those moving averages makes me want to reevaluate gold and silver. But it's been a long time since it stayed above the 50, and it's been almost a year since it broke below the 200-day moving average. Sometimes I want to drop into the broad market indices, and these are calculated from rolling up stocks. So the S&P 1500 actually has volume here. And then we have some eye charts, not eye charts like at the eye doctor, but just to give me an idea of strength or weakness in the market. So I see my bongos and my force are red. That's clearly weakness. As you can see on the S&P 1500, bouncing around between the 17 and the 50. I had a DI negative cross above the positive. So a lot of weakness there that I'd like to see get fixed. And we've had some porosity, to steal Gil's word, breaking below the 50-day moving average over the past, but I'm going to be nervous the deeper below it might get. We look at new highs versus new lows. The cumulative highs over the lows continues, the number of new highs versus new lows continues to trade above its moving average, which is good. And as you know, we've been in a pretty strong market for the year. In the bottom, we get an idea of light green, new highs, new lows, less than 0 but greater than 65. Dark green, take number of new highs minus new number of lows, more than 65. And then if it's negative, you have more new lows than new highs, as we had on Wednesday and Thursday. It goes red. And you can see we popped up green on Friday after a couple days pulling back. Let's look at some of the accumulation distribution. You can see the E's crossed over the A's. So the D's and the E's are going up and the A's and the B's are going down. That's never good. So again, evidence of deterioration. Obviously, that could turn around at some point in the future. If you look at A's versus E's, and then you look at the percent of A's and B's above their 10-day moving average, the market goes up when you're above that moving average. The market's in pain when you're below the moving average. And we're pretty deep below that moving average here. So market clearly under pressure with weakening internals. If you look at each, this is another thing that is concerning, or maybe it's optimistic that we're going to get a rebound. And it shows you the percent of the index of the stocks in the S&P 1500 above their 20, 30, 50, and 200-day moving averages. And then they put the respective moving average on them. And what you want to see is the index above the blue, above the red, which is the moving average. And you can see that all of them are in decline, again showing the weakness in the market overall. So the market's got some weakness, no surprise, getting near points of of support. So if you're going to see a bounce, one would hope to see the bounce soon. And if you don't see a bounce, then maybe we've got the start of something bad. The Canaries and the LLURs make me feel good and optimistic, but some of these internals and based on the fact that we're due a correction have me concerned. Next thing I'd like to do is jump down to the industry groups. And as you can see, we have 145 of them right now in HGSI. And I like to look at the force index. And I want to look at the 2-day force to figure out what's working now. So we'll look at the 2-day force, which is price change and volume. I see only 45. They were over 80 last week, or up. And to the downside, haven't had a lot come in, only 4. So just to very quickly look at what's not working right now. Oil exploration, gas and equipment services, so Halliburton, Schlumberger, I suspect, are out this. Don't really know much about Secor. It's an expensive stock. So these should not look good. Let me go into a stock view. My bad. And if you wanted a clean view, which sometimes I'll look at, you could see how the 17 is crossed below the 50. The price is below the 50 on Secor. That certainly is not a very bullish-looking chart. Now, HGSI, you create your own, and this is the one that I like to use. And it's cluttered, I know, but it adds the fact that it had a pocket pivot down on Friday. Negative bongos, negative force, clearly a place that I don't want to be buying. So oil services weak. What else? Regional banks. These have been strong for some time. I know I got stopped out of my key on Friday or on Thursday maybe. Let's just take a look at a couple of these because these have been leaders. And you can see that they've certainly over the last 2 weeks have given up a lot of their strength. That's Commerce Bank shares, Webster Financial. See how the negative pocket pivots, everything up here turning red. Glacier Bancorp rolling over. So weakness in the regional banks. Now just to point out up here are the Hindenburg signals that I generated in HGSI, and I was using the bar chart, I believe. Let me take a look at that right now, actually. I'm using HGSI All NYSE Index. If I put the bar chart indexes on, and remember I mentioned before that your signals are dependent upon what you're using, you'll notice that they probably change and they disappear. So if you're not seeing any Hindenburg omens, make sure you go back in and you put the All NYSE. And again, this has to do more with what's being included in the index rather than changing any of the formulas for the Hindenburg. And that should bring them back. So regional banks are weak, and building products. What's interesting is even though the indices are weak, only 4 groups actually made it to this list, while 45. So as part of high growth stock investing, what I typically do is top-down investing is I want to look at these top 10. So very quickly, application, software, and index. You know, Adobe I thought they had crappy earnings, to be honest with you. And I thought it was going to be a problem on this day. And you could see Adobe had a Bible gap up, a DI crossover. So pull back to the 50 and then a Bible gap up on Friday might be something to keep your eye on. So even though I thought the numbers looked bad, Wall Street loved them. It makes money, although slowing earnings per share growth. Maybe they liked the fact that they had a lot of people sign up for their cloud. But pull back to the 50, Bible gap up, DI crossover, and read Morales and Ketzer, and they'll tell you how to manage these. But as long as this doesn't take out the low of the day, I might be willing to play a little bit with Adobe Systems, currently in the highest ranked group. Netquin has been a tough stock to own. Remember, it's price change times volume over 2 days, and the volume on Netquin was 3.5 million shares, and so that's probably driving this as much as anything else up to the top. It's a Chinese stock play that has potential some accounting issues, and I lost money in it and would stay away from it now. Don't know anything about Cimatron going sideways, had a kahuna come in. Looks like it wants to break out of a squeeze. Everything is green, doesn't make any money. So I usually look at the top couple. Let me see if there's anything else here that looked interesting. Solar Winds actually look pretty good. I don't like its earnings per share story, but I'm learning to ignore earnings. Deep pullback, broke above the 50, had a kahuna. Some volume came in with a pocket pivot. Just a run up to the 200-day moving average would still be a 20% gain from here. Not a great story because it's in a downtrend. I prefer to buy stocks in an uptrend that have pulled back, but potentially at a decent buy point. So that was the first group. Not that exciting except for Adobe. Internet retail, can you say Facebook? I've been saying that this probably needs to be in your portfolio. Pull back here, sort of a perfect looking cup. Had a kahuna on Thursday and a pocket pivot, breaking out here, not quite to new highs, but everything is green here, DI crossover. If this market turns around and goes up, I think Facebook is a leader. Amazon.com, what a great stock, what a great company. Look at the earnings going to be starting to come into the stock. I'm not sure I like their drone-related delivery system. Looks like it's setting up here. Does it want to run again? It's expensive, but maybe it should be expensive. It's certainly a leader in our time. I don't like to go below the index, so even though there are additional stocks below the index, we're going to just move on. We're going to just go back. I realize I did something wrong here. Yeah, I was on the wrong combo ring. So internet retailer is actually number 1. Application software, which is Adobe, is number 2. And there's Solar Winds that I looked at. Netquin actually drops down a little bit when I do it the right way because I had it on the wrong ranking. Third group down are airlines. I think it's a new world. I think airlines are actually investments now, and I have a big position in Delta Airlines. And you could see UAL pull back to the 17, and basing there maybe wants to run. I don't like the earnings per share growth, and then I look at Delta, and I get pretty excited. I think all of them are going to go up. I think the industry has changed. You've gotten rid of Continental, Northwest, well, either USA or American, pick one, and everybody said you needed to have 3 mainline carriers for them to make money, and you got them. You got the Delta system, the American US system, and the United Continental system. As a very frequent flyer, I could tell you I'm almost never on a plane that isn't full. And their prices have gone up, as are all the things that they charge you for. So I think this is a secular change, and you'll continue to see strength in the airlines. Copa Holdings is another one I like. Nice base here. South American Airlines makes money with earnings per share growth. Looks to me like it broke out of a squeeze on Friday with a kahuna. So there's a lot to like in the airlines. Here's Southwest is another one. Southwest, has more and more competition on the low end, but continues to take share. It's making money. It's got growth in earnings per share, and it's given us a nice opportunity to buy after setting up here. So I think the airlines look as strong as anything, and you probably need to be owning at least one of them. Internet software and services. Trulia, here's the leader. Let's take a look at a couple of them. Now, sold off pretty hard, pocket pivot here. Kind of looks like a reversal to me, but it's below the 200. I usually don't buy below the 200. Did have a Bible gap up on, it's a green, I'm sorry, not a Bible gap up. It had a green candle low here. So it looks like a reversal, but it's a stock that pulled back pretty hard. I might watch it for a couple days. Doesn't make any earnings per share growth, but it had huge volume coming in last week, so maybe it's setting up. Alchemy Technologies, it's pulled back to the 200. It's gone sideways. So I like this and I don't like this. I like it because I've got a stock that's been basing on the 200-day for a couple of weeks now. I like it because I had a couple of kahunas come into the stock last week. Shows me some interest is coming. I had a DI crossover. Still got some red up top, which bothers me. My big concern is I got to get above this 50-day moving average in blue for me to believe that anything has changed here. And I just don't know if that's going to happen or not. So I might put a buy stop in if it takes out the high of Friday. I might want to wait to see to get above the 50, but I'm interested in it, especially with those kahunas coming in. Yahoo, I don't get this one at all. I guess people like the CEO and they like their Alibaba stake. I don't use it, don't know anybody else that uses it, although I still have an old Yahoo email address. Lower left, upper right, it's a leader of our time. It's doubled since the beginning of the year. Everything is green. Not a whole lot of earnings per share growth coming into the stock. So I think it's more of a story than a fundamental strong. Rackspace, hard to get interested here, way below the 200-day moving average. This is one that I have holdings in. It's a Chinese real estate website. It's tough to own, guys. You have to sometimes pinch your nose and not pay attention. Now, this is one that I bought at this breakout right here. And I bought it, and actually it was $42 when I bought it. So it must have been back here. So I've got a ton of profits in it. So I give it some rope, which is sort of where my swings turn into positions. But this one is probably, of all my holdings, has got the most volatility, but it continues to go up. The fundamentals, I think, are slowing, and I'm going to probably tighten up my stops, especially the market rolls. But this has been a big leader for me this year. Interactive Corp, not quite a lower left to upper right, but breaking through the top of the Bollinger Band. Everything is green, but tepid earnings per share growth going out. But it's been in a good group. So some things may appeal to you there. I made my comments. Apparel, luxury goods. I asked my wife who Quicksilver was, and she said it didn't impress me that it's a great story. It's a cheap company, probably in the teenage side. See, $8 stock. Now, you might like it because it pulled back to the 50, had a Bible gap up on Friday, got above the 50 on the Bible gap up on Friday, green candle low on Thursday. I'm not that excited. I look at the earnings per share growth. Yes, maybe it's a turnaround coming, but it just doesn't make that much money. Ralph Lauren, a couple pocket pivots, a couple kahunas. You're buying it off the 200, the 50 is below, lots of things turning green, not that exciting from my perspective. VF Corp has really been a great stock over the years, and there was some news about, I don't know if they have a big split coming. They own a lot of great brands, and you could see lower left, and it got stuck here, and it's running again, a couple pocket pivots on Friday. Are you noticing there aren't a whole lot of great stocks to buy right now? Probably a little bit better than it was last week, but it's still pretty awful. Casinos and gaming, the next list. Last week I liked it maybe a little bit better, and there's a number of stocks, two of which I own in the top 4. Here's MGM Resorts. Last week we talked about it breaking above the 50. You could have made a couple bucks if you bought it. It's kind of breaking out to all-time highs. Broke out of a squeeze down here. Has earnings per share coming in, although it doesn't make a whole lot of money. Mostly green up top. I own Las Vegas Sands and MPEL. Wins another, probably the leader of the group. These are when you buy them. You buy them when they pull back to support. You look up here, red candle high at a high jump a couple days ago. It certainly is extended. Again, I own Las Vegas Sands, which also is getting extended. This is when you want to buy these stocks off of major moving averages. Everything that's green makes money. My favorite one is MPEL. I have a long-term position, and I actually bought more when it pulled back down to the 50 because that's been a good place over the years to buy it. I like this one. It's got better earnings, but what it really has that I really like is the fact that it's all about Macau, which is why the other gaming stocks seem to be doing well. So gaming, like airlines, may have some interesting things in them. Industrial conglomerates, the only one that really made sense here was GE. A lot of things in GE, including finance. I looked at the chart, and it's like, let's put up a, for example, let's put up a monthly chart, a weekly chart rather. So on a weekly basis, it's gone from 14 to 28 in the last 2 years, so it's at a double over 2 years, so sort of a box 2 or 3 stock in that basis, but not based upon earnings per share growth, which remains tepid. Sort of more, I think, about getting back to its 2008 levels, and you could see prior to the market collapse, it was a $40 stock, slowly working its way back. Not exactly a high growth stock, and one that you might be interested in it as a measure of the economy. It pays a small dividend. It made the list, but it also has 39 million shares traded, so it needs just a positive close to make it on this list. Hotel, resorts, and cruise lines, hardly ever see that one. Boy, has it come a long way. Carnival makes this list. Again, I'm not seeing charts jumping up and smacking me saying, buy me, buy me, buy me, and this one doesn't either. I mean, it's sideways. Had a kahuna pocket pivot, DI cross, everything turned green, hip-de-doo-da. It's also in a quagmire. Maybe it's going to squeeze here, maybe it's going to break out, maybe it's going through a good season. I don't know. I'm not that interested. Starwood, a little bit nicer looking pattern. Basing here, had a couple of kahunas, a pocket pivot volume coming in. Still red on the Bongo Daily, don't like the earnings per share growth. Like the properties, pays a small dividend at 1.8%. See if there's anything here that's worth looking at. Yeah, although I do think it's interesting that multiple cruise lines made it. Maybe it's just the season. Coal and consumables. There was some strength in natural gas last week, and that's probably what drove this. And then there's a lot of talk that show that although we're sort of bearish on coal in this country, that internationally the number of new coal-based electricity plants continues to go up. And that there's a lot of folks that are bullish on coal. And then remember, coal comes in different varieties. It comes in metallurgic for making steel, as well as I'm not sure what they call the other coal for running the electricity plants. So sun, coke, energy, steelwork, blast furnaces, metallurgical coal, and it's had a nice run up here and pulled back, and then in a pocket pivot up and a Bible gap up on Friday. Not your traditional coal stocks that are making it here. Consolidated Energy is, I think it's called bituminous coal. I can't remember what the other, here it is. The 2-minute is coal. This is for that goes into the electricity. And, you know, if you bought coal on the lows, like people like, what's his name, the super stock guy talked about, God, I can't believe I'm having a mental block. Shame on me. Jesse Stein talked about coal way back here. Some of the leaders or other stocks, like Walter Energy is the one that I've made some money on of late, and you'll see similar patterns, but off of from a 9 up to 18. And then, you know, these 200-day moving averages, they're there for a reason. Stocks don't get above them very easily. And until you get above that 200, you're in a downtrend. ANR has been another. This one actually broke above the 200 and then lost it here on this week. So I'm not sure I'm too excited by coal. I'm kind of shocked that it made its way into the top 10. Construction, farm and machinery, I did like Wabtec and Trinity. There's a number of stocks here that maybe are interesting. So as you probably are well aware, there's been a renaissance in the railways related to transportation of energy. This is the lower left, upper right. This is Wabtec. Kahuna's Thursday and Friday. Huge volume on Friday with a pocket pivot. Everything is green. Not great earnings per share growth. Trades at a multiple of 23. Pays a dinky little dividend. Clearly has been a leader. Obviously, you want to buy this. At times it pulls close to support here at the 50, but it looks like it wants to run again. Caterpillar, less exciting, although it did break above the 200. The other one I liked was Trinity, another thing in the train business. Pulled back to the 50, had a DI crossover here, still negative on the bongos, but look at the earnings per share growth coming into this stock. Federal Signal is a smaller truck maker, cheap stock, and it pulled back. You know, I'll give it some porosity here. It stayed above its 65-day exponential, whatever that means. And if I can get a kahuna and break above this 50 here, I might be getting interested in this stock. It too has great earnings per share growth. So as I look at these groups, what stood out to me was airlines, casinos, construction, and machinery. Notice what's not up here. Home builders, I mean, all this talk about their back, and then I look at their charts. You know, look at this one, so I may have to eat crow. It was up 8.5% for the week. And what I see are stocks that I still got to get above the 200. So until I see some consistent movement above the 200-day moving average in this group, here's Ryland, here is M&I, Meritage, maybe a little bit above, not Meritage, but M&I, and here's Lennar. And this is what you see as you continually test its resistance and you come back into support. So I'm not buying home builders yet. What else didn't I talk about today that's fallen a little bit out of favor? Pharma and biotech. And in fact, they're not even here. So the fact they're on neither list tells me they're sort of going sideways as groups and not stand out to the up or to the down. So we've looked at top-down investing. We've looked at the market, which has clearly got some counter forces, I guess is one way of saying it, going on right now. We identified some strength in the groups. Now very quickly, let's see if I can find some things that are working. If I go into warehouse group, and I go into all stocks, all securities, and then I go into Woodward and Brown. I'm going to go into the traditional ones. Hold on a second. Woodward and Brown. And I'm still using the August 15th archives, reference, you can say it with me, miscellaneous, because I do this every time. And then I look for sprinters, and I now bring it down to 37 stocks. So this is bottoms up. I'm not looking top down. I'm looking at stocks that are standouts. So how do I know they're standouts? They're all bongo daily, so none of them are in pullbacks. Almost all of them except for one are bongo weekly. Okay, I see sea of green here, relative strength rank. They're all above 90% except for the last one. Their ERGs are all above 240 except for two. Accumulation distribution are all A's and B's, and many of them are box stocks. So this Sprinter one-step with Bongo isolates some stocks that have been performing well with good fundamentals. So let's look at a couple of them very quickly. Some I recognize as doing well. All right, that's pretty, isn't it? Nielsen Holdings, big move. I'm concerned about this. It's at the high jump. It's had a big run. Pocket pivot, Kahuna and volume coming in. Maybe it's got another big leg up. Maybe that's a blow off top, but certainly a leader. Here's iGate. I don't love the earnings on this, but I do like the chart. A more gradual ascent. Had a red candle high, but it's nowhere close to the high jump here. Looks like it wants to run. It's at a high. I don't love the earnings per share growth. Media General, MEG. My old boss's name was Meg, so that's the reason I should buy it. I don't see any earnings coming in the next 2 quarters. Big earnings last quarter, which makes me scratch my head about these and recognize that nothing is perfect and there might be earnings there. Big bullish move here. This was a Mobo breakout from a squeeze, running up like a straight line. Everything is green, clearly a leader. eHouse China. This one, it stubbed its toes. We talked about it a couple of weeks ago. It's running again. Has great earnings per share. Usually the second quarter I ignore because it's subject to a lot of changes. YRC Worldwide has been selling off. I would call this a bottom fish because it's below the 20-day moving average, but it broke above the 50. Multiple kahunas. Everything here is turning green. I don't understand this stock. It seems to lose a ton of money, yet it wants to run up. And this is a stock that had a big run up into the last few weeks. You can't see it here. Never mind. And it's because at one point the stock had a huge valuation. There must have been some reverse splits here, the way the chart looks like. Martha Stewart, Omni-Media, don't know what happened here. Pull back towards the 50, 2 kahunas, big volume, everything is green. So these might be stocks you might want to be looking at. Illumina and the Life Technologies business, big multiple stock. Roche is in it, out of it as far as buying it. Don't know what's moving it right now. Makes money, everything is green. So the point is that bottoms up is another technique, and here is a way of finding with the Sprinter one-step with bongos some stocks that look great. Here's another thing that I've been doing, and I tried doing this last time and it wasn't on that computer. So I'm going to look at stocks that are more than $2 at 150,000 shares, who on Friday were both their forces were positive and they had a kahuna, and were within 3% of free parking. So that means these stocks should be in uptrends. They're above their 200-day moving average. They must be in pullbacks because they got closer to the 50, and they had a kahuna. So I should be finding stocks that are either basing or pulled back to their 50-day moving average that took off on Friday with a forces positive and a kahuna. Now I had a question came in about how do I find within 3% of free parking. So if I add it, you can see percent current interval from 50-day less than 3 or greater than -3. So that would be anything between -3% and 3% above the 50-day moving average. So let's see if we found anything with this little scan. Again, another way of scanning to find stocks to buy. Tronox is one of the ones that made it to George Lee's list with multiple breakouts on Friday. And I see a couple of other things that I thought were interesting. So, not a beautiful uptrend, certainly a deep pullback, broke above the 50 and the 200 on Friday with a kahuna, huge volume, a Bible gap up, everything's turning green. I got to figure out what the story is here. I also know from the George Lee stuff that had a Mogo breakout, a PSAR breakout, pocket pivot, and a Bible gap up. So that's an interesting stock. Okay, chart, don't know about, here's Akamai, we looked at that before, in an uptrend, it's above the 200, pulled back, it's below the 50, but it had a kahuna. We talked about that as being interesting. Here's Starwood, we looked at them, again, a stock in an uptrend. Now it hasn't pulled back to the 50 as far as but it's gone sideways, and the 50's caught up, setting a squeeze here, a couple pocket pivots, volume. and kahunas. Vulcan Materials, haven't looked at this one. Here's a stock that was at a short-term uptrend, pulled back. So none of these necessarily are perfect, but what I'm able to do is to find stocks, here's that Quicksilver, that have pulled back and gave me a kahuna showing volume and momentum perhaps coming into the stock. Packaging Corporation America, clearly in an uptrend, pulled back, went sideways, and then on Friday had a DI crossover, start green on the forces, and a kahuna. So that's another trick that I do to find stocks, is I have a number of scans set up, and this is to find stocks in uptrend, pulling back to free parking, which is the 50-day moving average, and then throwing a kahuna with positive force. Lastly, a very quick group inclusion filter. Let's look at the top 10 stocks of this, and then I want to say goodnight. So I go into Tools, Group Inclusion Report, and then I hit Clear, and I open up Smart Groups. I go into Morales and Catcher, and I care about viable gap ups and pocket pivots. I go into Woodward and Brown, and let's look at best criteria, best of, best under 15, demand, growth, HS 100 leaders, QEPs, stocks and groups to the upside, strong EPS, turnaround. I want to make a group from list. I'm going to call it Web Gem 12.15.13. I only want 10. I'm going to hit OK. It's now going to go through the list, count up how many stocks each stock is in the list, and it's going to show me the stocks that were in the majority of the lists. Drum roll. Let's see what we got. So this shows you here some of those stocks, and these are the number of lists they were in. Or we can very quickly go back into the designer, find my web gems from 1215, and let's take a quick look and see if any of these bring us something else to look at, and then we're going to say goodnight. So the first one we got is Ambarella, young stock, running up, pulled back a little bit to the 17. Don't like its earnings per share growth. Everything is green, which I do like. Might be a good opportune time to buy it. Aspen Technology, great earnings per share growth off a small base. In an uptrend off the 200, pulled back to the 17. Pocket pivot, DI crossover, looks like something to look at. eHouse China, we already looked at it, one of the Chinese internet retailers. Here's KS. Here's a stock in a nice uptrend, based here, and then a couple kahunas Thursday and Friday, volume of pocket pivot, everything is green. I've learned from Ian, when I see multiple kahunas and a pocket pivot, I get interested. Great earnings per share growth, and they pay no dividend. That's Capstone KS, one of the best-looking charts that we've looked at. Here's MPEL, the Macau-based gaming stock I told you about. New Skin, too much like Herbalife for my taste, but great earnings per share growth, and has certainly been a market leader with skin preparations, vertical marketing. Here's that SoFun, that real estate internet site, very volatile. And then we've talked about this several times, Winnebago. Hard to believe that this and Thor are doing so well, but there must be a resurgence in RVs. Had hit in a flag, broke above the flag. Kind of sideways, less exciting than the others. It's got good earnings per share growth. And then Maria Baltaramo's husband's company, it's run from 7 to 15, so it's had a double in a year. Wisdom Tree, red on the Bailey Bongo, showing that it's pulled back. I want to see a reason. I want to see a kahuna or a pocket pivot to jump into this. Not a whole lot happening there right now. So on that note, let me just show you the stocks that I got interested this weekend that made it into my quote-unquote buy list, whatever that means. Just means that they were setting up, and it means that I'm going to be watching them as the week goes by. And user group, 1215, buy watch. So many of these we've looked at before. Gentium Spa is a small biotech that's in a huge move that we pointed out 2 weeks ago, up 2 weeks in a row in double digits. Here's your Wabtec, a couple more paper companies. In fact, let me just do it this way. 2 aerospace, 2 airlines, application software, only 1 biotech, a number of pharmas, activists, Jazz, Lynette, Valiant, some of my favorites, some generic houses there. Couple oil expirations, and these are not buys right now. And of course, I hit tankers. So the tankers, the shippers and the tankers looked interesting to me. So hold on to oil expiration. Stock in an uptrend, pulled back, beats the 200, a couple of kahunas, broke above the 50. Everything is green, great earnings per share growth. I think these stocks have a ton of debt, but I thought I got interested in the shippers. Diana's another one that had a big day on Friday, broke above its 50-day moving average, pocket pivot, and a kahuna as well that I thought was interesting. Barrow has, to me, one of the classic charts, a specialty chemical company. When I say classic of what I like to buy. Uptrend, pull back to the 50. Now, I watch this. I don't jump until it does something. So my setup is uptrend, pull back to the 50. My trigger is going to be something. Is it a kahuna? Is it a pocket pivot? Is it a bullish engulfing pattern? Is viable gap up? I'm looking for a trigger. But my setup is here. It makes money with great earnings per share growth. Clear uptrend, pull back to free parking. All I need is a kahuna, and I'm in. So Faro is one that stood out for me. And I was talking about the oil expirations, and I'm going to stop. You can stop this if you want to see my list. I'm not saying to buy any of these. What I'm saying is that they pull back pretty hard, and a lot of them look like this. Giving you a doji here, look, okay? And so you had a green candle low doji occurring on Friday. Big earnings per share growth, does not pay a dividend. This could fall all the way down to 200 and get below the 200, but I watch. This again, a buy list for me is a watch list where I am looking for this to give me evidence that it's changing its tune and maybe it's going to go back up. But that evidence has to be a signal. Kahuna, a pocket pivot, a viable gap up, a morning star. So this list here is a list of setups. I'll buy those that have triggers. I looked at 500 charts to find 47 that I'm interested in and a nominal number of groups. On that note, I say good night. Let's take a quick look at the futures, and they're now down big, so that China thing that I showed you probably is weighing in on them, and not much to say except the futures are down big right now. Good luck. Be safe. Look forward to seeing as many of you as possible. That's double-edged sword because I don't have unlimited space at the meeting on the 15th. And again, the big news here, I may have opened up the wrong one, is that we have dropped the price because I was able to get a better price on the room. February 15th to 16th, Jeffrey at High Growth Stock Doc, and good night, everybody.